Welcome to Smart Wealth with Joshua.
Your daily stock analysis and catalysts talk. Today we're looking at BigBear.ai.
If you find our talks useful, please consider subscribe, like, and comment underneath.
So to start us off today, I want you to really picture a scenario.
Okay, let's hear it.
Imagine opening your portfolio app on like a random Tuesday morning. You pull up one of your holdings and you see a headline that just makes your stomach drop. Top-line revenue has plummeted by 38%.
Oh, wow. Yeah, that is not what you want to see with your morning coffee.
Exactly. And if you are, like most people, managing their own wealth, your finger is probably hovering right over the sell button. I mean, panic sets in, right?
Absolutely. 38% is a massive haircut.
But what if I told you that this massive, terrifying drop in revenue might actually be, well, the smartest thing that company's management has ever done?
I mean, I'd say you're crazy, but knowing how these markets work, I'm definitely listening.
It is entirely counterintuitive. But when you strip away the immediate emotional reaction and look at the actual financial plumbing of what is happening inside BigBear.ai right now, you start to see this very deliberate, high-risk, high-reward turnaround story taking shape.
Right, in the defense and artificial intelligence sector.
Yeah. And because of that, we are currently stamping the situation with a 6 out of 10 on the bullish scale.
Okay, so I want to break down that 6 out of 10 score right away, because for you, the listener, trying to figure out where this fits into your wealth building strategy, you need to understand this is not a set-it-and-forget-it blue-chip stock.
No, definitely not.
You are not buying this to just collect a steady 3% dividend while you sleep. A 6 out of 10 means we see tangible, aggressive upside, but, it requires an iron stomach for volatility.
Because the company is fundamentally rewiring its entire business model.
Right. Which brings us to that ugly headline number. To understand the rewiring, we really have to look at the pain they're taking right now. BigBear.ai recently reported their fourth quarter 2025 revenue at $27.3 million.
Yeah, that is the 38% year-over-year decline we just mentioned.
Yeah.
And their loss per share was 4 cents.
Now, interestingly, that 4-cent loss actually beat Wall Street's consensus estimate of a 5-cent loss.
Which is something.
Right, but the raw revenue drop is what grabs all the headlines. I am looking at these numbers, and I have to admit I'm kind of confused. As an investor, you were taught that revenue growth is the oxygen of any technology company.
For sure. It's the golden rule.
So why would any executive team voluntarily choke off their own oxygen supply? I mean, how does killing 38% of your revenue not immediately destroy the stock?
Because, simply put, not all revenue is created equal. Management is actively allowing certain lower-margin, labor-intensive Army programs to just expire. They're deliberately shrinking their footprint in legacy consulting contracts. In the defense world, we often call this the body shop model.
Let me make sure I understand the mechanics of that just for our listeners. A body shop model means the government says, hey, we need 50 engineers to manage this database for a year.
Right, exactly.
So the company has to go out, hire 50 people with security clearances, pay their salaries, pay their benefits, and maybe, just maybe, they scrape a tiny profit margin off the top of that billing rate.
That is the exact mechanism. And when you have a labor-based contract like that, your profit margins are permanently capped by human physics.
Because you can't just magically make 50 people do the work of 1,000.
Exactly. To make more money, you are forced to hire more people, which means more overhead, more HR issues, more management headaches. It is a linear, exhausting, and just highly inefficient way to grow a business.
So bringing this back to your portfolio, think about this like a wildly popular packed restaurant in your neighborhood. And suddenly they announce they're completely shutting down their lunch service.
I love this analogy, yeah.
Right. So if you are just a passerby looking at the raw number of customers walking through the door, the overall daily foot traffic drops dramatically. It looks like the business is failing.
It looks empty half the day.
Exactly. But what the owners are actually doing is taking all those resources, the kitchen staff, the ingredient budget, the mental energy, and reallocating them to focus exclusively on a high-end, incredibly expensive dinner service.
And take that restaurant analogy a step further. Imagine the new dinner menu requires specialized ingredients that only a few chefs in the world even know how to prepare.
Oh, I see where you're going.
Right, and they can charge 10 times the price for it. In the case of BigBear.ai, that high-end dinner service is software as a service, or SaaS.
Got it.
They are transitioning from renting out human labor to selling highly scalable software platforms. With a SaaS model, you write the software infrastructure once, then you can deploy it across a dozen different military agencies with incredibly high margins because, it doesn't really cost you anything extra to add that next user.
So you are basically trading top-line vanity metrics, just looking big on paper, for bottom-line financial health.
Exactly.
But shrinking your business on purpose is terrifying. It's really only a viable wealth-building strategy if the company actually has the financial runway to survive the transition.
That's the catch.
Because I've seen so many tech companies attempt this exact pivot, and they simply run out of cash and go bankrupt before the new high-margin software business can take off.
Which is exactly why we need to talk about the financial miracle that just occurred on their balance sheet.
Okay, tell me about that.
So if you were tracking this stock just a short time ago, it was essentially trading as a distressed credit play. I mean, the market thought they were going to drown in their own obligations.
They were in deep trouble.
Very deep. But they recently pulled off a massive financial restructuring and eliminated approximately 90% of their long-term debt.
Wait, hold on. 90% of their debt is just gone.
God.
How does a struggling company pull that off? That doesn't just happen by accident.
No, it happens through aggressive, backroom financial restructuring. And while the exact granular mechanics of their specific creditor negotiations are pretty complex, generally, a company in this position goes to their lenders and negotiates a restructuring.
Like trading debt for equity.
Exactly. Trading debt for equity or renegotiating the terms just to clear the slate. The creditors realize that a healthy, unburdened company is worth more to everyone than a bankrupt one.
That makes total sense.
And the result for the investors at the threat of insolvency, which was acting like a wet blanket on the stock price, is suddenly just removed.
So the narrative completely flips. When a company is drowning in debt, every single dollar of free cash flow, the cash left over after simply keeping the lights on, is already spoken for by the bank.
You're just working for the lenders at that point.
Exactly. You can't invest in new technology because you're too busy paying interest. So by wiping out that debt and building up to record cash levels, they transform from a company playing desperate defense to a company with a clean platform for growth.
They finally have the liquidity to invest in research and development without constantly looking over their shoulder at debt covenants. But having a pile of cash and no debt is really only half the battle.
Right. What's the other half?
Well, to actually build wealth for shareholders, they need a defensible position in the market. They need a moat.
Okay, let's talk about that competitive moat, because this is where I really need to play devil's advocate for the listener.
Bring it on.
So, BigBear.ai operates in what they brand as decision intelligence. They have tools like TrueFace, which handles complex facial recognition, and Veraskin, which does identity verification.
Right.
And they are deploying these tools inside the Department of Defense, the National Security Agency, and the Air Force. But let's be real here for a second. Artificial intelligence is the most crowded sector on Earth right now. You have massive tech giants in Silicon Valley with practically infinite budgets building world-changing, multi-billion-dollar AI models. Why wouldn't the Pentagon just buy off-the-shelf technology from one of those titans? I mean, why on earth do they need this specific small defense contractor?
It is the most common misconception about defense tech. You cannot just take a commercially available large language model from Silicon Valley and, plug it into the National Security Agency's classified servers.
I suppose not.
The competitive moat here is not just the underlying code, it is the clearances. Operating in these environments requires specialized, exhaustive government vetting.
So you're saying their moat is essentially made out of bureaucratic red tape and extreme background checks.
Well, it is much more robust than that. Let me give you an example. Imagine a special operative scanning their face to enter a secure facility in a hostile region.
Okay, high stakes.
Very high stakes. The system verifying that identity, something like Veraskin, has to be hardwired into classified networks that are completely isolated from the public internet. Building an architecture from the ground up that meets those classified standards takes years of auditing.
Right.
And once a company is embedded in those high-stakes networks, the switching costs become astronomically high.
Because ripping out the old system and installing a new one would require the government to start that multi-year security audit all over again.
Exactly. The government isn't going to halt national security operations to swap in a generic Silicon Valley product just because it has a slightly better user interface. That operational friction is what protects this company's future cash flows.
Okay, that makes sense. We have a secure, deeply embedded moat and a newly pristine balance sheet with record cash. So naturally, the next question for anyone holding this stock is, how are they going to spend that cash to return to actual growth?
Right, because you cannot just sit on a pile of money forever while your legacy revenue shrinks. Well, management is moving fast on this front. They are utilizing that clean balance sheet to execute strategic mergers and acquisitions.
Oh, M&A. Okay.
Yeah. Recently, they acquired Ask Sage, a company focused on secure generative AI, and CargoSeer, which specializes in highly complex supply chain logistics.
Which aligns perfectly with the moat we just discussed. I mean, they aren't trying to build consumer chatbots to help people write emails. They are buying the specific pieces they need to offer a comprehensive software suite to the military.
Exactly. CargoSeer helps track physical assets. Ask Sage helps analyze the data securely.
But there's another major strategic move happening right now that introduces a massive new risk vector, doesn't it?
Yeah.
I mean, they have confirmed a deliberate pivot toward international expansion,
They have, yes.
specifically targeting public sector projects in the Middle East.
Right, and the Middle East is currently pouring billions of dollars into AI and digital transformation across their public sectors. For a company selling sovereign, highly secure AI solutions, there are incredibly lucrative contracts on the table.
Let's strip the optimism out of that for a second, though, because expanding internationally is notoriously brutal.
It is.
The cultural complexity is massive, the sales cycles are entirely different, and the regulatory environments are completely foreign.
Oh, absolutely.
We just spent the first 10 minutes of this analysis talking about how they had to slash their domestic legacy Army contracts because they were too hard to manage. Are we really supposed to believe that a company right in the middle of a painful domestic restructuring can successfully execute a global pivot without spreading itself entirely too thin?
That tension you are highlighting is the defining execution risk of this entire investment thesis. You are absolutely right to be skeptical.
It just seems like a lot all at once.
It is a lot. Operating in the Middle East requires localized expertise and huge upfront investments in relationship building. It is not easy. However, from the perspective of the executive team, the Middle Eastern public sector represents a massive greenfield opportunity for their new SaaS products. If they can secure just one or two major sovereign contracts over there, it instantly validates the new software business model and rapidly replaces all the revenue they lost from the legacy Army contracts. It is a calculated gamble using their new cash cushion.
All right, so we have the fundamental business strategy clearly mapped out here. Shrink the low-margin revenue, kill the debt, leverage the government moat, and push into the Middle East with newly acquired tech.
That's the playbook.
But how is the actual stock market digesting this incredibly complex story? Let's dive into the price action and Wall Street sentiment, because this is where theory meets your actual portfolio balance. As of early March 2026, the stock is trading around $4.04.
Which presents a fascinating technical picture. The stock is significantly down from its 52-week high of $9.37.
Yeah, that's a big drop.
That drop represents the visceral pain of the 38% revenue contraction. The market punished them for it. However, the stock has found very strong buyer support well above its low of $2.36.
And here's a crucial lesson in market psychology for anyone listening. You really have to pay closer attention to how the market reacts to news, rather than just the news itself.
That is so true.
Because when they released that seemingly horrific fourth quarter earnings report with the massive revenue drop, the stock initially dipped, but then buyers aggressively stepped in, and it actually rallied 5.5%.
Yeah.
And then, when the CargoSeer acquisition was announced, the stock surged 7.3%.
Right, and when a stock rallies on objectively bad headline news, it almost always indicates that the worst-case scenario was already priced into the valuation.
The sellers are simply exhausted.
Exactly. The broader market looked at that 38% drop and essentially said, well, we knew that was coming, but look at the fact that the debt is completely gone. Institutional buyers are actively stepping in to defend the valuation around these $4 levels.
But if you look at the professional analysts at major financial institutions, Wall Street is still incredibly cautious, like even outright bearish. On average, price targets have been cut by about 16%, bringing the consensus down to around $5.44.
Yeah, it's a mixed bag.
Cantor Fitzgerald recently maintained a neutral rating, but lowered their specific target to $5.
So why are the professional analysts so sour while the technical buyers are stepping in?
It really comes down to how Wall Street builds their financial models. Analysts rely heavily on trailing data, meaning historical performance and near-term visibility.
Okay.
Imagine an analyst sitting at a desk in New York. They plug a 38% top-line revenue contraction into a traditional Excel valuation model, and the formula mechanically spits out a lower price target. They're currently in what we call a show-me phase.
Ah, gotcha. They need proof. Exactly. They acknowledge that the balance sheet is fixed, but they refuse to assign a higher valuation premium until management actually proves they can generate that new high-margin SaaS revenue. They are heavily penalizing the stock for the execution risk in the Middle East.
Which brings us to one of the most intriguing contrarian signals we've seen on this stock.
Yeah.
While the analysts are busy cutting their targets, we saw a highly notable insider transaction.
This is a fun one.
Yeah, U.S. Representative Lisa McClain bought over $16,000 worth of the stock in early March. Now, I'm going to be the skeptic again here. For a successful politician, $16,000 is practically pennies.
Sure.
I mean, it's the cost of a used Honda Civic. It is a tiny fraction of a typical congressional portfolio. Should an everyday investor really care about such a small dollar amount?
It is entirely fair to question the nominal dollar value. But in the context of congressional trading, the absolute dollar amount matters far less than the signaling value.
Okay, how so?
This is not just a random executive buying shares in their own company. This is a legislative insider. Representatives who sit on relevant committees have forward-looking visibility into upcoming defense budget allocations, geopolitical shifts, and regulatory trends that the general public won't see for months.
So it's less about the $16,000 and more about the fact that someone whose daily job involves looking at classified national security threat assessments and defense budgets decided this specific $4 AI company was a smart place to park their own money.
Exactly. It serves as a powerful signal of confidence. It suggests that the overarching sector of decision intelligence is fundamentally vital to national interests, and that this company's specific suite of clearances aligns with where the federal money will be flowing in the coming years.
It's dead crumb.
Yeah.
Yeah.
It provides a very real bullish counterweight to those bearish analyst notes.
Okay, but no wealth-building strategy is complete without a strict, unblinking assessment of the risks. We've talked about the turnaround, the cash, and the upside, but what exactly could go wrong here? If a listener is considering adding this to their portfolio, what does the bear case look like?
Well, the most immediate risk is simply revenue volatility caused by their customer base. We constantly use the phrase lumpy government contracts. Let me explain what that actually means in practice.
Please do.
You might have a verbal agreement with a defense agency in March for a $10 million software deployment. But then the Appropriations Committee delays a vote, or Congress passes a continuing resolution, and suddenly the actual cash doesn't hit your company's books until October.
Oh, wow. So your quarterly earnings look terrible, even though the business is actually fine.
Precisely. And because they have historically operated with negative profit margins, some analysts consider the stock expensive despite the sell-off. If those new Middle East contracts stall out, or if integrating Ask Sage and CargoSeer turns into a logistical nightmare, the revenue recovery timeline gets pushed back.
And then you are left holding a company that isn't growing and isn't profitable, even with the clean balance sheet.
Exactly. The entire thesis rests on their ability to execute this pivot seamlessly.
Which is exactly why you cannot just buy this stock and ignore it. You have to monitor the catalyst calendar tightly over the next 90 days. We are looking at 3 specific events that will dictate the direction of this valuation.
Let's weave those catalysts together. First, we are looking toward early June 2026 for their Q1 earnings report. Management has boldly issued guidance signaling a return to actual growth in 2026.
Right.
June is the moment of truth where we find out if that guidance is rooted in reality or if it was just optimistic corporate spin. The market is going to be relentlessly searching for any proof that revenue is finally stabilizing.
Simultaneously, you need to be watching the wires for any official announcements regarding those Middle East contract awards. Management has aggressively touted this international pivot. Now they need to deliver the actual signed contracts.
Yes, a major sovereign contract win would act as an immediate, violent upside catalyst for the stock, proving the SaaS model works globally.
And as we move into the middle of the year, we enter the prime season for debates over the U.S. defense budget for fiscal year 2027. You want to pay close attention to the language coming out of those congressional committees regarding artificial intelligence spending priorities.
Right, because if decision intelligence gets a massive funding carve-out, a rising tide lifts all cleared defense contractors. But before we wrap up the core analysis, we really have to look at one of the biggest rumors floating around this ticker.
Oh, the takeover rumor. Yeah, the defense tech sector is always buzzing with rumors, but the financial plumbing we just discussed makes this one incredibly
It
plausible.
really does.
There is widespread speculation that by completely eliminating 90% of their debt, BigBear.ai has fundamentally positioned itself as a prime debt, mergers and acquisitions takeover target.
Think about this from the perspective of a massive legacy defense prime contractor. You have these huge corporations that are desperate to modernize and bolt on true, cleared artificial intelligence capabilities.
Right.
For years, they might have looked at this smaller company and thought, we absolutely love their technology and we covet their deep access to the NSA, but we are not going to absorb their toxic, debt-laden balance sheet.
But now the house is completely clean. The debt is gone. The balance sheet is pristine. They have essentially engineered themselves into the perfect bite-sized acquisition target for a much larger player.
Exactly. A giant defense prime could simply buy them to get immediate access to those high-security government contracts, completely bypassing the 5 years of red tape required to build their own Clued AI division.
Right. Why build it when you can buy it on a discount?
Exactly. And while it remains a rumor, the mechanics of that debt reduction point strongly toward this as a highly logical endgame.
So let's bring this all together and summarize the wealth-building takeaway for you. We started by stamping this with a 6 out of 10 bullish score. The elevator pitch is this. This is an asymmetric, highly speculative play that requires a 6 to 12-month holding period.
That's the time frame.
You are making a calculated bet that the broader market is currently too distracted by the ugly 38% trailing revenue decline and is subsequently failing to properly value the massive 90% debt reduction, the strategic pivot to high-margin software, and the positive insider buying signals.
You are essentially buying a clean balance sheet and waiting for the new revenue to catch up to the narrative. If management successfully executes the Middle East expansion and integrates their new acquisitions, the market will likely be willing to pay a much higher premium for the stock. But if they fail to execute, you are holding a stagnant tech company heavily reliant on unpredictable government spending.
It is entirely a question of your personal risk tolerance.
Yeah.
If you've been holding this stock since it was at $9, looking at that $4 price tag probably hurts. But if you strip the emotion out of it, the underlying business is arguably healthier today than it was at its peak.
I would agree with that.
As we close out today's analysis, I want to leave you with a completely different angle to ponder. Something that goes beyond just this single stock and touches on the entire future of the technology sector.
The broader implications of the moat we discussed earlier.
Exactly. We spent a lot of time talking about how difficult it is to get security clearances and how that protects BigBear.ai from generic competition. But think about what that means on a macro level. We are currently watching the massive trillion-dollar Silicon Valley tech giants build the most powerful AI models in human history.
It's incredible to watch.
It really is.
Yeah.
Yet they cannot easily deploy them in the most critical national security environments because of regulatory firewalls and security protocols.
It creates a bifurcated market.
Yes. Ponder this. Are we witnessing the permanent fracturing of the AI industry? Will we forever have a division between commercial AI, the tools everyday people and businesses use, and sovereign AI, the highly regulated clearance-gated tools used by governments and militaries?
It's a huge philosophical and financial question.
And if a relatively small company can build a moat this deep just by passing government background checks and hardwiring into secure servers, what does that mean for the true valuation of those massive Silicon Valley giants who might be permanently locked out of the most lucrative government contracts in the world? Think about how that divide shapes the next decade of tech investing, and you might just see entirely new ways to position your portfolio.